I'm going to spend the next 20 minutes or so just talking you through how we think about our product design and our business build out. And in particular, how we do that from a client-centric perspective. And specifically, how we can do that when we put the client first, but against the backdrop of those sort of key tenets of the Diginex ethos. Most notably, I want to focus on these recurring themes of transparency and fairness that ultimately lead to trust. So broadly speaking, you could classify most of our current and potential and also future customers as one or other of traditional investors or crypto native. Now, those crypto native or digital native, they've sort of been born and grown up with this technology. And on the other side, we have our traditional customers who are really now seeing that the digital asset space is here to stay. And they really are feeling that sort of gravitational pull. Now, what's common amongst our peers is that you'll see that they tend to focus on one or the other. And really, we don't see them as being mutually exclusive. And in fact, what we're trying to do is grow that overlap. And in fact, we feel responsible for growing that overlap as we demonstrate the benefits to the traditional investors. Now, a lot of time and thought, particularly with regard to our product sort of design and our product platform, has gone into how we can make everything that we do familiar for both of these customer segments. So what I want to do is just give you a couple of high-level examples of where you can see this within our business lines. Then I'll go on and speak more granularly about some product and processes within our EQUOS exchange platform. So if we look first at securitization. Now here, Richard and Shane touched upon the opportunity that really is still developing in this space. So within our capital markets business, what we're looking to do is create deals that are available in both traditional long-form contracts or as digital securities. So really, we're not trying to compete with the token issuance platforms that you might already be familiar and have come across. But we're also not trying to force traditional investors to take deals in a format that they might not yet be sort of truly comfortable with. So therefore, investors in these deals, they have the opportunity to move from one format to another during the life of that transaction. And again, it's about driving that overlap of the customer base. So because we don't have that requirement or need to be in a digital format, really the option is there for people to adopt the benefits as and when they see fit. And I've highlighted a couple here, most notably around sort of customer and cap table data management or verification or integration of that data. It might well be smart contract automation, or the one that catches most people's eyes, and that's really the opportunity that comes from secondary market trading. Now, those new to the space that do take up this digital asset opportunity, they can truly feel protected and confident that they've got that safety net there, that they can go back to a deal that they know and understand. But for those that are already comfortable in the digital landscape, they're not being precluded from deals that were previously only offered in traditional format. But they also then aren't being burdened with some of the, I guess, administrative costs or friction that comes from having to take a deal in paper format when they're set up to really enjoy the benefits of technology. Now, really what we're trying to do here is future-proof all of our deals that we're involved in. Because as Richard mentioned, the adoption rate is increasing and the regulatory framework surrounding digital assets, and in particularly digital securities, is constantly evolving. And so here, all of our deals are ready for those changes. Now, we're obviously able to build products. So then how do we trade and manage that? So here we point to Diginex Access. So as you're now aware, this is our trading and technology platform where we've teamed up with best-in-class partners such as Itiviti, and you'll hear more from them in the CEO Spotlight. But it's imperative to us that we were able to appeal to both new and existing traders. So on the traditional side, those who are familiar with these platforms, they could be sure that their risk and their monitoring and the management of this new asset class easily ties into their existing framework. So this really for them was a plug and play. Now, those who are already active in the space, now they have this opportunity to adopt this best practice from traditional finance by bringing institutional grade assistance and infrastructure into a sector that really now more than ever is rewarding that true sense of risk management and governance. Ultimately, though, the sort of common ground for all traders is around execution. And here we've built an algo suite that, whilst conceived out of traditional finance, has been finely tuned to the intricacies of trading digital assets. So in this sense, we see Access as this truly one-size-fits-all solution for the space. Now, as has been mentioned, Access is multi-venue, and therefore it is the sort of natural connection to that broader digital liquidity ecosystem. And our contribution to that ecosystem, as Richard mentioned, is EQUOS, our exchange platform in Singapore. Now here, we have a focus around product and process design, but I want to be clear, and as Richard mentioned, EQUOS really is at the center of everything that we're doing as we strive for those benefits of liquidity. So whilst we might have a number of different business lines, building that sort of interconnected ecosystem and actually mirroring a lot of what's successful at the prime brokerage or the private bank models is key to what we're seeing as being successful. So integrating custody, trading, and execution with that focus on clients and their asset efficiency, whilst doing so against the backdrop of transparency and fairness and compliance, is truly where we think we'll be successful. So if we start with a bit of our thought process behind, say, our spot markets, but in reality, it's around the platform in general. What was clear to us, and again, I sort of going back to that concept of our two customer types and creating that overlap, is we wanted to appeal to both of those customers, but in a way that they were comfortable with. So if you were digitally native, we wanted to make sure that that was something, that was natural to you. But also, if you weren't yet really ready to be truly digital native, you weren't put off by what was on offer. So we didn't want to make ourselves this truly digital only platform, but we also didn't want to sit on the sidelines and wait for the next wave of institutions to truly accept the fact that digital assets are here to stay. So in order to do this, we wanted to make sure that customers had the ability to deposit assets onto the platform in a way that was simple, but also easily understood based on their own experiences. So as such, we've adopted a fairly unique approach to how our user accounts are actually managed. So effectively, a user can determine whether or not they wish to have their account denominated in US dollars, the fiat currency, or in USDC, which is our chosen settlement stablecoin. So those that choose an account in US dollars, for them, we effectively hold and manage their account in that currency as a risk. Then the same is then said for those that choose to manage their account in the digital currency. Now, one of the key arguments for digital assets is this reduction in friction caused by trading using traditional financial services methods and fiat currencies. So it would seem odd to us to then add this friction back into a system as we're thinking about design. In addition, a sort of second key argument behind the adoption of digital assets is these benefits of improved liquidity. So again, it would be sort of odd if we were to then segregate markets and create additional spot pairs, for example, a Bitcoin versus US dollars alongside a Bitcoin versus USDC. Now, if you look at most of the competing platforms, they've consolidated themselves to one or other. Now, yet in order to execute there, you'd invariably have to step through this process of getting your assets into the correct underlying base currency first and at your own cost. Now here at EQUOS, we allow you to still manage the assets in the risk currency of your choice, but we then allow trading to be able to consolidate down and execute on one single pair. So effectively, the trading, if you like, is agnostic as to whether or not the account is held in USD or USDC. So we've been able to manage that liquidity pool together, reduce the friction, as well as maintaining the customer's choice as to how they want to hold their assets on the platform. So in that sense, we've built what we feel is an effective fiat on-ramp, off-ramp for all customers, but doing so without adding any complexity or costs from their perspective. So now we've got customers with assets on the platform. It's then about the products they have access to. So we've spent a lot of time ensuring that our platform is accessible to all users. And now it's about sort of the product build out. As Richard and Shane both mentioned, really we see the opportunity set in the derivative space. Again, everything that we've built sort of sits on this same ethos of fairness and transparency. So what we want to do is start by having a look at the perpetual future. So this is a product that's commonplace across platforms in the virtual currency space. But we'd like to think we've made some unique amendments and differences that ensure that our offering will appeal to more users across more customer segments. Now, for anyone not familiar with a perpetual future, it's a financial instrument that effectively gives the buyer or seller the economic exposure to the underlying asset without actually having to buy it. Each buyer is netted off against a seller, but because you don't buy the underlying asset, you simply have exposure to the movement from when that trade came on. Sort of the best, I guess, analogy into traditional finance would be a perpetual swap. Now, virtual currency exchanges offer leverage on these. And to be clear, it's the exchanges that offer leverage. The product itself is not levered. So again, in traditional finance, this would have been a role that would have been taken up by a broker-dealer or prime broker. And here, that prime broker role is again being taken up by Diginex through EQUOS and integration with Digivolt. So when we looked at some other platforms' offerings, we wanted to ensure that we had a number of sort of key repeating themes. The first one was consistency. So other exchanges might have inverse futures, products denominated in BTC, USD, or even their own sort of private settlement coin. Some might be only derivatives, some might be only spot. We have a common settlement currency for all of our products. We offer spot and derivatives through the same platform. And where possible, we rely on our own data and our own pricing to manage risk and exposure. We do offer margin trading to customers, but we understand where the real risk to EQUOS is from these margin traders. Now, most large institutions want to take single-digit leverage. Most retail customers want to take a lot more. And it's about building that sort of fair and transparent liquidation process that I'm going to touch on later to ensure that our market remains robust and orderly. And then finally, I'll just touch on capital efficiency and understanding that risk of a client's whole portfolio and managing it accordingly rather than just looking in each piece independently is going to be a key driver. Again, this is all built on that concept of fairness and transparency. So to dive a little bit deeper into the perpetual future, and in particular with regard to funding. So as many of you may or may not be aware, perpetual futures on digital currencies have a funding process that occurs over fixed time intervals. Now, the fundamental difference with our calculations is the determination of how that funding payment is made. So Diginex has great pedigree when it comes to trading experience across a range of asset classes. One of the key points we wanted to ensure that when we create a product and that product itself derives a payment, you can justify that payment. When I say justify, I mean you can see exactly how it's defined and calculated. So these funding payments in their basic form are just a function of the spot market and the futures market. However, when you look at a lot of the other platforms, in order to calculate that payment, it requires input from a multitude of other platforms for spot prices and fairly complicated methodologies. Now that leads to more than a slightly opaque calculation, and replication becomes almost impossible. So for EQUOS, this basis payment is calculated purely on the perpetual future price on our platform and the spot price on our platform. So having both the spot and derivatives within the same ecosystem allows us to ensure that the calculation is firstly completely transparent and secondly completely replicable. So for any arbitrage trader out there, they can easily be attracted to the opportunities that might arise should we see a reasonable spread appear between futures and spot prices. Again, it's about that simplicity and that transparency. Finally, I'd like just to touch on our liquidation process. Now, as many of you are aware, virtual currency marketplaces offer high leverage, and we often suffer with the sort of negative association that comes with that, particularly given how volatile the underlying is. Now, whilst we are able to offer high leverage exposures to clients who wish to take them, it was imperative to us that we built a system that could ensure the integrity of our platform, particularly during these volatile times. In addition, we needed to ensure that that process still followed those guidelines of fair and transparentness. Now, the liquidation process that we've implemented is something that we believe is a unique solution to the problem. So rather than just taking away someone's position from a customer at a price that is deemed either somewhat egregious or certainly not reflective of the current market price, but is a commonplace practice amongst some of the other competitors, we know that derivatives are going to be a key driver of P&L for so many of our customers, and therefore fair liquidation will be a key to keeping them on the platform. So how did we do that? Effectively, we've built a three-step process that shows that we acknowledge that the key to managing risk is accessing as much liquidity as possible. We know that on day one, that we're not the biggest exchange. We realize that managing risk will require us to access other platforms. And here I come back to Diginex Access that gives us that multi-platform availability. Now, what we've also done is invited other liquidity providers into that process. And now, naturally, as our liquidity grows on our platform, the requirement for liquidity on other platforms reduces. So we have a liquidation reserve. This is similar in some ways to the insurance funds you'll see at other platforms, and it is managed by our internal manager. But I want to be explicitly clear here and reiterate a point Richard made. We do not market make on our own exchange. Yet, we need to be able to reflect the liquidity of other platforms on the management of our liquidation positions without doing so. So to solve this, we built an effectively unique independent liquidation platform that manages liquidation risk through those invited liquidity partners, one of which is ourselves. And here we are effectively able to utilize liquidity from other platforms and balance sheets from other liquidity providers. Now, because we do this away from our own main order book, we don't then have liquidation causing cascading stops. So if we're able to reduce that direct impact of liquidations on order book, we're able to reduce the chance that our book cascades lower or even possibly higher. This independent process means we're able to reflect that broader market liquidity, but also ensure that it's a competitive and therefore fair market price for any liquidity, for anyone who's using our liquidity platform. Now, should the platform not be able to complete the order size, we're then able to move that through our public order book, which is generally the first step for most of our competitors. Then ultimately, if it can't be closed there, the position gets passed to our liquidation reserve before that customer runs out of capital. Now, unlike many other insurance funds, the mandate of our liquidation reserve is clearly different. The liquidation reserve is not tasked with making money for Diginex. That is the role of the exchange in this business line. So we don't want to grow a balance sheet asset beyond the risk management requirements for the platform. So we've dedicated a lot of time to analyzing the market risk on the platform. And whilst the liquidation reserve will grow with trading volume and risk on the platform, it doesn't need to outsize that risk. The liquidation platform in itself gives us a process where we can dial up and dial down the risk capital we use to ensure that the customers get the fairest possible price for their liquidation. Now, hopefully these examples give you a better idea of how we think about the issues that we're facing and the products that we use to address them. I just want to spend the final couple of minutes just briefly covering some of the roadmap ahead of us. Now, as Richard laid out earlier, we are working towards a full derivatives platform. The current underlying focus for us is BTC and ETH. Now, as each of the products we produce, starting with spot and then futures, both perpetual and dated, right the way through to options and eventually some light exotics, we're going to start with those most common and liquid virtual currencies. And as each product beds down, the expansion of the underlying can then also be increased. So if we think about our product matrix, with the horizontal axis being products and underlying assets being vertical, we're initially going to go horizontal in terms of expansion. But once those building blocks are in place, we can really ramp the vertical quite aggressively. So from a product perspective, we're looking to release dated futures and options in the first half of the next calendar year. Now again, our dated futures will be physically settled USDC underlying. Our options will also be physically delivered and priced in USDC. And we think this is a fundamental requirement, not only for our customers, but also for our investment products business, as it slowly builds out its product offering in parallel. We also plan to, and will in fact, settle all of our dated products to a daily fixing. And again, it's one that can be replicated. I can't stress enough these points about transparency and replicability that I mentioned earlier. And even the CME contract that was been talked about before, I mean, that settles to an index of a multitude of different exchanges, making it almost impossible to manage at scale. And then finally, in addition to product expansion, there's also functionality in our roadmap that I'll briefly touch on. And primarily, this is again focused on capital efficiency. We believe that making it cost effective for users on the platform will be the key to that high customer retention rate. So we're one of the few houses that holds both spot and derivatives offerings together. And so as such, we want to leverage that when it comes to capital efficiency. So when you look at an account and a customer risk, we need to consider that holistically and on a portfolio basis. Now, just because a customer has a position that requires margin, it doesn't make sense to charge that margin unless that position is actually adding to the risk overall and not reducing it. So to give you a basic example, I could go to a spot exchange and buy some Bitcoin. I might hold that for a while and then make the decision that I want to hedge it with a futures position. I'd have to go then to a derivatives exchange to do that. Now, not only will that derivatives exchange require me to put capital on the exchange to put on that trade, they will then charge me margin, and they might actually even liquidate my position, despite the fact that as in holistically, I don't really have much risk because that derivatives exchange doesn't know that that spot exchange position exists. This issue is only exacerbated further depending on the denomination and the structure of that futures contract that you use. So on EQUOS, not only will we be able to manage the cross-collateral element, i.e. the funding of trades with different assets, as well as the borrowing and lending, but also consider the overall risk impact of each new position on the portfolio and look at that incremental change in risk and charge the appropriate margin for it. So this portfolio risk management of positions and collateral, we believe will be a key feature for institutional accounts that should ensure that they remain a very sticky customer base. Now, I hope I've been able to demonstrate some of the critical thinking that's gone into the business line approach, as well as the product design and implementation. And I hope that that demonstrates how we're aiming to provide a differentiated offering from those that you've already seen out there.